2 weeks from tomorrow is your tax filing deadline. Have you filed your taxes yet? Well, on the program, we're going to talk about some of the unique tax issues that you may want to be thinking about, particularly if you haven't filed your tax return, or maybe if you filed your tax return, maybe you missed some of these, and so you may want to change it in light of what we'll talk about today. Plus, speaking of taxes and filing taxes, is an IRS audit in your future? It might very well be, given some of the stats that we're going to share with you on the program today. The folks in Washington are looking specifically about this notion of a tax gap, the difference between what actually is collected by the IRS versus what should have been collected by the IRS based upon current rules. So we've got much to talk about, IRS flavor, tax flavor on the program today, obviously with 2 weeks out before the official tax filing deadline. So welcome to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you here on the News Radio WFLA Orlando network, along with 96.9 The Game. In a few weeks, we're going to be adding another station to our reach, and that is the folks over on the Space Coast are going to be able to hear the program on a more regular basis because we're coming to them on WMMB, that's 92.7. So excited to add another station to the lineup. Of course, we're also one of the top 25 financial planning podcasts on the World Wide Web. So be sure and subscribe to us on your favorite podcast channel. My name, Joel Garris. I'm the host of the program. My company, Nelson Financial Planning, has a team of certified financial fiduciaries ready to help you this week change your life with a successful and cost-effective financial plan. So May 17th, right, around the corner. So we wanted to give you some last-minute sort of tips and considerations. There's certainly a lot of changes this year. Each year sort of creates a unique year, but certainly for 2020, the tax return that is getting filed now, there was a big difference between some of the changes that happened. And so we're going to run through some of them and hopefully highlight them, make sure you didn't sort of forget them on your tax return. Of course, biggest of them was the stimulus check, right? That was a big difference, something very, very new for 2020. We're now up to 3 rounds of checks. So last summer, you should have gotten $1,200 and then followed that up at the end of the year, beginning of this year, to the tune of $600. Those first two were 2020 income items. Not income in terms of you've got to report it and pay taxes on it, but you've got to put it on the return and sort of true it up, if you will. Now, if you got those stimulus checks and you didn't deserve them because your income was higher than the applicable thresholds, well, that's okay, you get to keep them. But if you didn't get them and you should have gotten them, the only way to recover that is through the 2020 return. That's why those stimulus checks are so important, to know the amount you got and to verify that through the use of your 2020 return, because the amount of stimulus that you actually got depended sort of upon which tax return you had on file at the time that those checks were issued. So it's an array of your 2019 return, your 2020 return, and for some folks, even their future 2021 return, where they'll be sort of truing up the third round of stimulus, which happened about a month or so ago, and that one was for $1,400. So remember, the third round had much tighter thresholds in terms of eligibility, right? So if you were single, making between $75,000, no longer could you get a partial stimulus check up to $100,000 of income, but instead that top threshold was cut down to $80,000. Same thing for a married couple. Instead of $150,000 all the way out to $200,000 of income, for the third round, the range was cut to $150,000 to $160,000 of income. So much narrower ranges of eligibility for the third round of the stimulus check, which is why it sort of mattered which return you had on file, in order to drive the largest amount of stimulus checks. Another item that was unique for the 2020 return was this notion of charitable contributions and being able to write off charitable contributions as a top line item, meaning that you didn't have to itemize your deductions in order to get a deduction for your charitable contributions. That is brand new for 2020. The reality is, though, it was only limited to $300, and when they wrote the tax code, they only said $300 per return, which means that even a married couple could only write $300 off on those types of charitable contributions. The good news is they fixed that for 2021, so a married couple is going to be able to do that for $600, but for 2020, it's only $300 per return. It's got to be cash, okay? It can't be dropping some stuff off at Goodwill or the like. It has to be cash in order to get that charitable contribution deduction that is an above the line deduction. Most folks should see a minus $300 or $300 input on their tax returns, because the reality is most folks have generally contributed to something, whether that's to your local SPCA or your scouting organizations or whatever the case may be. Most folks would certainly find that they would qualify for at least that $300 number. Another big change for last year, and this was one of those late ones that came in, that has to deal with unemployment compensation. The first $10,200, not taxable, assuming your income is below $150,000. That does not include the $10,200 of unemployment. On a show about a month ago, we went into deep detail on how this unemployment thing, this tax-free unemployment thing works. It's very unique because they set the threshold at eligibility less than $150,000 per return. They did not distinguish between single, married filing separate, head of household, or married filing joint. So what that does, it creates an opportunity where if you traditionally in the past would have filed a joint return, maybe you wanted to consider doing a separate return in order to trigger eligibility for that tax-free treatment of unemployment. So very unique twist, particularly on the unemployment, particularly how they sort of specified who would get the tax-free treatment of that. So just be aware of that big change as well. Of course, the reality is that up until your tax filing deadline, then you do have the ability to make IRA contributions or Roth contributions, all of which are still available up until May the 17th. If you're self-employed, you can even do a SEP IRA. All of that's still available to do within the next couple of weeks prior to the tax filing deadline of May 17th. Now, one of the interesting things that we have talked about previously on the show is the difference between IRA versus Roth. And obviously with an IRA, you get a tax deduction on it, but when you take it out, you have to pay taxes on it when you are in retirement. On a Roth account, it's after tax, so you don't get a tax deduction now, but then it comes out as tax-free. The interesting thing is that with tax brackets as low as they are, it's starting to counsel folks to do the Roth more now, particularly if you find yourself in the 12% income tax bracket. That bracket actually exists all the way up to about $100,000 of total income for a married couple. So that income tax rate is a pretty low amount that ultimately winds up being a benefit to folks that are in that low of a tax bracket, that they can take advantage of maybe doing a Roth instead of a traditional IRA, because I don't think that tax bracket, that low of a tax bracket, is going to stay. We're going to take a break. When we return, we're going to continue the conversation on some tax tips looking ahead over the course of the next couple of weeks here on Dollars and Cents with Joel Garris. On the program today, we're talking about some of the tax things that folks need to know, particularly for the 2020 tax return, especially given that as of tomorrow, there's 2 weeks to hit the regular tax filing deadline. We talked in the prior segment about this notion of charitable contributions, being able to make take a deduction for charitable contributions up to $300. And that's an above the line deduction. So pretty much everybody should be able to kind of take that one. Don't need to itemize your deductions to be able to do that. This notion of unemployment compensation being tax-free, up to the first 10,200 of it, assuming your income is less than 150,000. Big caveat there is you really, if you're filing a joint return and you're above that $150,000 threshold cumulatively, you may want to look at filing a married filing separate return in order to take advantage of that tax-free treatment of your unemployment. And then of course the stimulus checks, right? Came out in 3 rounds, and the reality is that the first 2 rounds are actually 2020 items to consider for on your income tax return for 2020. The reality, of course, is that that's the best way to sort of true that up if you did not get the full amount of those first 2 rounds of stimulus checks. Interestingly, we had this conversation at the office just this past week with our team, and of course, as many of you know, our team consists of a CPA, and a member of the team is an IRS enrolled agent. And so we talked about this, and it was actually a situation involving someone who had a newborn baby, new child, in I think it was October. Okay, so they had a newborn in October. No, that wasn't it. It was earlier than that because they would have been eligible for the second round. So let's say it was July. Okay, so they had the newborn in no, that's right. Sorry. See how confusing this can be even for me. The reality is that they had the newborn in October. Okay, so I was making the assumption that, well, I could certainly see where that newborn would be eligible for round 2, right? As a dependent on parents' tax return, eligible for round 2 of the stimulus because that happened at the end of the year. And obviously the child was around at the end of the year. But interestingly, after our analysis of the tax code, what the tax code does is it actually looks at whether the child was alive at the end of the year, and if that was the case, then that made the child eligible for both rounds of the stimulus check. So kind of one of those interesting things that even though, so the child wasn't alive for round 1, but based upon our interpretation of the tax code, the child was in fact eligible by being on the tax return for 2020. The child was eligible to garner the dependent check for the stimulus of round 1 and also round 2. So certainly some very unique things that are playing out on these stimulus checks, and that was just one of the ones that just popped up this past week for a newborn being eligible for a prior round of stimulus when in fact they weren't actually alive. Hey, the program was designed to give as much money as possible to American consumers, and so that's obviously what happened there. That's for sure. Anyway, we were also talking a little bit about this notion that if you're in the 12% income tax bracket, then at 12%, that's a relatively low tax rate. And the reality is that you may not see that low of a tax rate going forward because that's a historically low rate, particularly if you think going forward over the course of the next 10, 20, 30 years. And so it tilts sort of the analysis or the advice more towards the Roth than perhaps it previously had been in the past. So if you're looking at the option to be able to fund something for retirement prior to May 17th for the year 2020, it's not too late. If you're looking at an IRA versus a Roth, again, look at your tax bracket. If you're in that lower tax bracket, then the Roth really may make some sense to do that. In addition to that, you could also look at whether there's an opportunity to do some conversion as well, an IRA conversion. That's something that we typically don't talk a lot about on the program because I don't like the notion of prepaying my taxes, if you will, to the IRS. But in this particular case, again, if you find yourself in that 12% income tax bracket and there's an opportunity to say, fill up that bracket, if you will, maybe you can get another 10 or 20,000 of income and ultimately still stay in that 12% bracket, then there's an option, an opportunity to sort of do a conversion. That would certainly make some sense. Beware there that you don't trip up on making your Social Security taxable or something like that. That could be have a doubling up effect of that tax implication. So make sure you kind of look at the numbers and run it. But certainly some interesting opportunities about contributing to Roths or even a conversion, particularly if you find yourself in that 12% income tax bracket. Another item that has been around for a little bit, so not new for 2020, but obviously qualified charitable distributions. We can't say enough about the power of these. They are very unique. To the extent that you're charitable minded, then the reality is that being able to have that charitable donation go directly from your IRA, it's got to go direct. The check's got to be made payable directly to your directly to the charity in order to have it count. But being able to do a qualified charitable distribution, and when you do that, it basically offsets the income. So let's say that you've got a required distribution of $10,000 and you have $5,000 of that go directly to your church or your favorite charity or whatever that case may be. Well, that means on your tax return, you only have to report 5,000 of the 10,000 as income on your tax return. You don't have to report the other 5 that went directly to the charity. Here's the thing on that. Again, based upon our interpretation, we had another conversation as a team this past week. The reality is that that really is only available for folks in a traditional required minimum distribution format, meaning it's your IRA, you're over age 70 and a half, and that qualified charitable distribution is in fact available. Now, yes, they did change the required minimum distribution age to 72, but for the qualified charitable distributions, it stayed at 70 and a half. So an important nuance there, if you will, on how the qualified charitable distribution works. Basically, again, our interpretation, if you are getting a required distribution from a beneficiary IRA, the qualified charitable distribution option doesn't really exist for you. It's only for account owners and their required minimum distributions and having those go direct to a charity of their choice. And then lastly, something everybody that kind of needs to be thinking about, particularly as you retire, when you're working, right, your employer takes care of your taxes. It comes out of your paycheck and it goes automatically. You got nothing to worry about. When you're retired, that's when you got to deal with it. And so you have to make sure that you are having enough tax withheld on the various income items that you're getting, whether that be your pension, whether that be your Social Security, whether that be your required minimum distribution. All of those you can do tax withholding on. And so consequently, ultimately, remember, in retirement, it's your responsibility to pay your taxes. So ultimately, what that means is that you've got to make sure that you're doing some proper tax withholding on those various income items that are coming into you on a regular basis. Otherwise, you're going to have a surprise come tax time. So even though you may be retiring or retired, you think, oh, well, I don't have to worry about taxes as much. Well, unfortunately, yes, you do. And in fact, you probably got to worry about them a little bit more, because now it's on you to be able to adjust exactly what your tax bill is going to be. So just some important things to note, particularly as we're 2 weeks out to the tax filing deadline. Certainly some big changes that occurred that you will see if you're processing through your 2020 return, or maybe you already processed it and some of the things that we just shared with you says, oh, wait a minute, maybe I didn't do that right. I need to take another look. Well, make sure you take another look at it, because there's definitely some big changes on that 2020 tax return. With that, we'll take a break here on Dollars and Cents. This is Joel Garris, Nelson Financial Planning. You're listening to News Radio WFLA Orlando, along with 96.9 The Game. Is there an IRS audit in your future? More importantly, how do you avoid it? This past week, we heard President Biden speak to a joint session of Congress, and of course, the conversation was about tax changes, and certainly we talked about those at length on last week's program. But there's another aspect that is sort of going unsaid in a lot of this conversation about taxes, and that's this notion of enforcement, collecting what should be being collected based upon just the current law. So when you start to kind of look at some of the conversation that's coming out of Washington, there's one conclusion that you can draw, which is that the frequency of IRS audits may very well be increasing. So on this segment, we're going to talk about what's going on there, along with how you avoid said audit. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. Most recently, in a couple of weeks, we'll be expanding to a third station here in Central Florida. The folks over on the Space Coast are going to be able to listen to us on WMMB 92.7. So we're excited to now be sort of fully covering the Central Florida region with our program, which, by the way, also happens to be one of the top 25 financial planning podcasts on the World Wide Web. So be sure and check us out on your favorite podcast channel. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that provides superior investment results and produces peace of mind for the future. So what are we talking about when we talk about this sort of tax gap? And what's that conversation all about when you hear the folks in Washington talk about greater level of enforcement? Well, the difference between what the IRS collects and what they should be collecting based upon current law is called the tax gap. And this seems to be sort of a growing concern and potentially a much greater focus of the IRS. Because here's the thing, you don't need the tax laws to change to collect more revenue. You don't have to go through Congress and fight it out and come to a resolution. The tax gap is just simply enforcing what's already on the books. And here's how staggering the numbers are and why I think it's getting more and more attention in Washington. So 2 weeks ago, the current IRS commissioner, a guy by the name of Charles Rettig, said at a Senate Finance Committee meeting that the IRS is missing out on approximately $1 trillion every year. What was dramatic about that? Well, first of all, that's a dramatically big number, number one. But number two, what was also dramatic about that is that was a significant increase over what had been previous estimates of that tax gap. The previously reported most recent official IRS estimate put the tax gap at about $441 billion. And then with their compliance efforts, it reduced that down to $381 billion. So tax gap about $381 billion. Here's the interesting thing on those numbers when you stop and think about them. So the IRS, based upon the numbers, and these numbers come from like 2013, that tax gap at $441 billion, meaning that they should have been collecting $441 billion more than what they were, but people weren't behaving properly on their tax return. And their compliance effort brought that down to $381 billion. That's only 15%. So yes, the IRS has achieved some level of compliance, but when you think about they're only capturing about 15% of the revenue from non-compliance or tax gap, it does make you kind of wonder why, or what they need to do to be doing that differently, particularly in light of some of the changes that have occurred in society over the course of the past few years. Chief among them is this notion of cryptocurrency. The IRS seems to be really focusing in on that. We've talked about this in prior programs. The 2020 return, talking about some of the big changes that happened on the 2020 tax return in the first half of the program. And this was one we didn't mention because we're going to mention it here. For the first time ever on the tax return, there is a question. And it's a very broad, and it's a very general, and it's a very open-ended question, and it's intentionally worded that way. And the question goes like this: have you sold, exchanged, purchased, or otherwise acquired any interest in any cryptocurrency? You have to mark yes or no? And that question, very obvious location, right below your name, social security number, and address, boom, there's the question on the tax return. And that's interesting because that is sort of a direct contrast to what used to always be the tax gap that was pointed out by people, and that was sort of the underground economy, right? When you pay folks in cash, the reality is that that was, for many, many years and decades really, thought of as that's where the tax gap, or a lot of the tax gap, was occurring. When you're paying people in cash, they put it in their pocket and they're not really bothering to report it as revenue. It's interesting, and I guess a sign of the times, that the focus has now shifted over to cryptocurrency, more technology, and they're truly ramping up with the tracking of that cryptocurrency, particularly with the question that they're asking on 2020 return. And so the difficulty with that is that one of the sort of appeals, if you will, of cryptocurrency is that it's non-traceable. At the same point in time, that's what makes it difficult to monitor from a tax perspective. It also makes it difficult if you're trying to report it on your taxes, because it's certainly creating a bigger burden on taxpayers who have engaged in some of this cryptocurrency stuff, that they've got to track pretty much everything that they do with it. And it's not like the platforms where you're trading cryptocurrency don't generate out like 1099-Bs, or there's not a single entity, or there's no tracking of the transaction, because again, that's part of the appeal to it. So if you're doing cryptocurrency transactions, you better be keeping some pretty good records, because the IRS is really almost like shifting with the times, if you think about it, right? The tax gap that used to exist was sort of the underground economy that was the cash economy, right? The guy paying somebody cash and he's taking it and putting it in his pocket and not bothering to report that as revenue. Now it's interesting, the focus has kind of shifted more to, okay, well, what's going on? New technology, new means of transactions, new means of exchange, and that's specifically what the IRS is now looking at. So it's incumbent upon folks, as with anything when it comes to your tax return, to make sure you're keeping good records across the board on that, because certainly that is one area of focus that the folks at the IRS really are focusing on. We got some additional thoughts on this matter, along with what to do if you are caught by an IRS scammer on the phone. Coming up next here on the next segment here on the program, Dollars and Cents with Joel Garris. Talking about the possibility of an IRS audit in your future, and certainly the conversation out of Washington is the increase in enforcement of the current rules that are already on the books. We see that particularly playing out with the question that's on the 2020 return, asking folks if they had anything to do with cryptocurrency of any kind. The IRS wants to know. The IRS views that as a source of potential revenue, and much like in the past where they have been trying to get at sort of the cash or the underground economy that exists when people pay in cash, now with cryptocurrency there are electronic records that in fact do exist on that, and so they're looking at that as an opportunity to help raise revenue. The key piece of that is make sure you've got good records and can sort of track those transactions when it comes to reporting on your tax return. Now, the other group that needs to worry about the potential of an IRS audit is the higher income workers. And that's the group where it's estimated that underreporting in the top 1% of income earners jumped by about 21%. In the bottom half of income taxpayers, that was only about 7%. So there's a much significantly greater opportunity to find underreporting and a bigger tax gap, particularly among higher income workers. And here's the statistic to sort of contrast that too, and one of the things that they're focusing specifically on, and that is IRS staffing. IRS staffing over the past 10 years, down 17,000 people in its enforcement wing. The current proposal, and again, this is why you're hearing about the current proposal in Washington, is to increase the budget of the IRS by approximately $1 billion per year. That would basically increase staffing by about 5,000 people. So bottom line, with these kinds of changes, with these kinds of approaches, with these kinds of the current thinking, if you will, you're going to see an increase in audits. How do you make sure that you're prepared should that happen to you? Well, number one, it's about record keeping. Make sure you're keeping accurate records, whether it's you fall into this cryptocurrency group or whether you fall into the higher income wage earners, which are also going to be more susceptible to audits. Make sure you're keeping accurate records. And then number two, don't lie. It's that simple. Don't make stuff up. The real issue always comes if stuff is made up. If it's a receipt for a dinner, make sure you've got the receipt. Don't make up the dinner that you never had. That's the key component to it. The IRS was not going to like it if you're making stuff up. Now, are you going to argue, well, was it a business, okay, or was it a entertainment, or those kinds of discussions are going to be the normal discussions you're going to have with the IRS. And at the end of the day, those are discussions that you have with the IRS when you're going through those conversations. But if you made up that, oh, I went out to dinner last night and you didn't, you were sitting on the couch, that's where the problems really is going to be for you. Speaking of problems, I don't know if this has happened. It's happening to a lot more Americans these days. The call from the IRS, which is not a real call, it is a fake call. So we're going to talk about some of the do's and don'ts next here in this segment. So this, of course, is Dollars and Cents. We're Central Florida's longest running radio program, coming to you on the News Radio WFLA Orlando network, along with 96.9 The Game. Joining soon in the network here in a couple of weeks, we'll be over on the Space Coast as well, WMMB 92.7. So we're excited for the program to be basically covering all of Central Florida now, with the addition of the folks over on the Space Coast. So we welcome them into the fold as well. Of course, it doesn't matter where you are in the world, you can check out our podcast on your favorite podcast channel provider. Recently named one of the top 25 financial planning podcasts on the World Wide Web. Make sure you check us out there. And of course, my name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning. So I don't know, I'm sure you've heard of these calls that people get from folks alleging to be an agent of the IRS, saying, you've got an unpaid bill, and if you don't pay it right now, you're going to go to jail. And over the course of the past 3 years, in fact, the Treasury Department received reports of more than 1.6 million calls from IRS impersonators, unfortunately capturing more than 8,600 victims. 8,600 people fell victim to this scam, losing a total of about $47 million. And a lot of these scams are long-running schemes. There's one of them, the biggest one that wound up getting cracked, was a bunch of call centers over in India using information from data brokers to find potential victims. Another option is that, and this has to deal with sophistication, right? It's become easier to become more sophisticated and make it seem like it's really the IRS, where they're even able to sort of trick your caller ID and ultimately have the number pop up as IRS. There's a couple of warning signs to just consider right out of the gate when it comes to this stuff. First of all, IRS doesn't call randomly out of the blue. They send their first shot over the bow through the mail. Number two, the IRS is scary, and understand they've got the power to jail you, but they're not going to threaten you. This is a legal process of that you wind up going through with the IRS. They are not going to threaten. They're not going to say the police are coming, you're going to go to jail, you got to pay immediately. That doesn't work that way. So just understand those two big kind of warning signs when it comes to that, and understand some of the basic do's and don'ts of what happens should you get that call from the IRS, right? So first on the list of do's, just hang up the phone. It's that simple, okay? Just hang it up, hit the button, and call is over. That's probably the easiest thing that you can do to avoid that. If the problem persists and you're getting a lot of these types of issues or calls, you may want to consider filing a fraud alert on your credit. That's relatively easy to do. You just simply call one of the 3 credit bureaus and ask them to place a fraud alert on your credit. I actually had to do that last year when I was getting calls from banks about accounts that I was setting up, and I wasn't setting accounts up. So file a fraud report or fraud alert on myself, and ultimately all of that stops. So know that if you keep kind of getting hit with these calls and these scams and stuff like that, you may want to consider putting a fraud alert. And then, of course, every person that works for the IRS has credentials and identification. And in fact, actual employees of the IRS have 2 official credentials, a pocket commission and an HSPD-12 card, which is a standard ID for federal workers. So if anybody's saying that they're the IRS, they should have that and have that card and have a number associated, an employee number associated with that card. So those are some of the things that you can do in reaction to being approached by one of these IRS scammers. What you should not do, is confirm personal or financial information over the phone to pretty much anyone. You also should not respond to an email or a text from the IRS. Again, IRS does it the good old-fashioned way: check your mail. And you certainly should not agree to pay a tax bill with a prepaid debit card or a wire transfer. That's not really how that works. And you certainly shouldn't be giving your credit card number or debit card number over to someone over the phone. The IRS has a secured website to use if you want to pay them by credit card or debit card. So understand that just because the caller may be showing that he's from the IRS on the caller ID, that there's a lot of scams to ultimately trick folks into thinking that it's the real IRS number. And then lastly, don't be bullied. These are criminals that are, if they're calling you and telling you you're going to go to jail, the reality is that that's not going to happen. So be aware, some warning signs, some do's and don'ts when it comes to dealing with those IRS impersonators. With that, we will wrap it all up and get on out of here. Thank you for listening to the show. As always, we'll be back next Sunday here on Dollars and Cents with Joel Garris of Nelson Financial Planning.